Okay guys, next concept is compound financial instruments. Sir, after our discussion, you touch any question, you should be able to answer on India's 32. Again, I am not going to cover each and every question on 32. 109 we will do everything. 32 is all theory questions, sir. All that examples only are these examples. Okay. Compound financial instrument. Watch this. As the name itself indicates, these are contracts which have the character of equity also, financial liability also. When you have equity character as well as financial liability character, that contract is called as a compound financial instrument. Sir, equity instrument ke accounting will be like equity share capital. One time you will account and you will leave it. Financial liability, some accounting is there which we will see in 109. But what if a particular contract contains the nature of equity also, financial liability also? You will learn in India's 109 later on that. For this, you have to do something like a split accounting. Some portion you will account it like an equity, some portion you will account it like a financial liability. Now we are not discussing accounting, we are only discussing the examples of CFI. First example, irredeemable debenture with mandatory interest. Since it is irredeemable, the principal amount, we don't have no obligation to pay. I may pay after 10 years voluntarily, but obligation to pay is not there. Therefore, this portion is equity plus. As far as every year interest is concerned, there is an obligation to pay cash. Therefore, this portion is a financial liability. Overall, this is a compound financial instrument. For this accounting, 109 lo detailedly we will see. It is there, part of your syllabus. Next one. Very common one this is in real life. Redeemable preference shares with discretionary dividend. Since it is redeemable, the principal portion whatever you have, you definitely have to pay. So have to pay. So obligation to pay exists. Therefore, this portion is a financial liability. But every year dividend whatever is there, the dividend you may declare dividend, you may not declare dividend. That is your wish. So here no obligation to pay. Sir, last 10 years low, one time also I did not declare, sir. Every year I paid dividend. Next 5 years also I'll pakka pay dividend, sir. You pay. Nobody is stopping you. But the point is, are you having a obligation to pay or not? You have to check. I have an intention to pay. Expectation to pay is completely different from obligation to pay. Obligation means unavoidable situation should be there. This is not unavoidable situation. If I want, I can stop and nobody can file a case on me if I don't declare dividend in a year. So I may pay, but I don't have an obligation to pay. Therefore, this portion is an equity. Overall, this becomes a compound financial instrument. Again, for this accounting is. Now tell me, sir, just for clarity purpose, cumulative preference shares or cumulative meaning is what? And what is the meaning of non-cumulative? Does it mean that it is mandatory? Cumulative, does it mean that the dividend is mandatory? Yes or no? Sir, you did so many sums in your CA inter. Tell me, did you ever see an item called as outstanding interest on debentures in the balance sheet? Outstanding interest on debentures. Interest unpaid on debentures. Did you see this item any time in the balance sheet? Every internal reconstruction sum low, it is there. Unpaid interest on debenture. Did you ever see arrears of preference dividend inside liability set balance sheet? But after the balance sheet date, after the balance sheet, note point it is written. Dividend is in arrears for 3 years, 5 years and all. Did you see there? That means preference dividend, whatever is there on cumulative preference shares, if it was compulsorily payable, it should be sitting inside the balance sheet, not outside. If somebody is sitting outside, he is not a liability. At least from that you should be able to guess the answer. No? Cumulative preference share does not mean that dividend is mandatory. Sir, first year I have a loss. I did not declare dividend. You can't ask me anything. Second year, I made huge profit, but still I don't declare dividend. Still you can't catch my collar. Third year, even bumper profit I made, 1 rupee also I did not pay. You can only see me, feel bad, curse me, but you can't demand dividend. Fourth year, I made super duper profit. Out of that profit, I am declaring dividend to my equity shareholders. Now you catch my hand here. You can't pay 1 rupee to equity shareholders before clearing our arrears of dividend. Adini right. Not to demand. Demanding right is not there for cumulative also. You understand, sir? Cumulative does not mean mandatory. If only cumulative was meaning mandatory, you would always see the arrears of dividend as a liability in the balance sheet. It will never appear anywhere. Same reason. Non-cumulative means if any particular year I don't declare dividend, over. A year ki your expectations are gone, you can't do anything for that. Future also I will not pay. Cumulative means in this year I did not pay, next year I did not pay, but whenever I pay, I have to pay you for all the years at once. And without clearing these arrears, I cannot pay 1 rupee also to my equity shareholders. And your law also gives right to cumulative preference shareholders that if you don't declare dividends for them, they have the right to attend general meetings or something like that for some matters. Their vote is also considered. ఇట్లాంటి రైట్స్ ఉంటాయి కానీ డిమాండింగ్ క్యాష్ అనే రైట్ ఈజ్ నాట్ దర్. బట్ ప్రిఫరెన్స్ షేర్ ఈజ్ ఎ కాంట్రాక్ట్. నో సార్, యూ కెన్ రైట్ ఎ కాంట్రాక్ట్ లైక్ దిస్. We people want a mandatory dividend. That means every year dividend company has to pay. Redemption definitely has to be done. In that case, principal financial liability A, dividend financial liability A, it won't become a CFI, it becomes a financial liability. I'm not saying mandatory dividend does not exist. It exists. But cumulative does not mean that. That's what I'm trying to say. Cumulative does not mean mandatory. Mandatory dividend is a separate case. If that is there, that is definitely an obligation to pay. But cumulative does not mean that. I mean to say that. Okay, sir. Last example. Very, very important. This is convertible instrument. Sir, whatever interest is there, whatever dividend is there, adi pakka we have to pay. There is no escape in that. Example, whatever I am giving. But the principal amount will be converted into equity shares. In these two cases are there. Convertible here, one small addition you make, no, or redeemable. I will see it properly. Convertible or redeemable at option of holder. Convertible or redeemable at option of issuer entity. Sir, I issued preference shares. Next 5 years, sir, dividend compulsorily I will pay, or debentures with interest compulsorily I will pay. Any case, at the end of 5th year, the preference shares will be paid in cash, or it will be converted into fixed number of equity shares. Two possibilities exist. Sir, who will decide? Anybody can decide depending on your agreement. So I am taking two possibilities. One possibility where the choice is there in the hands of the holder. If the holder asks you cash, you should pay cash. If he asks shares, you should issue shares. The other case is choice is there in the hands of entity. We will decide what is to be done. So first case, option is there in the hands of the holder. Imagine, sir, I am the entity. I issued preference shares, or let's say I issued convertible debentures or redeemable debentures. Next 5 years ki interest mandatory. Interest portion you leave it at pakka financial liability. Principal portion I am talking. After 5 years, as holders, you all people, if you ask cash, I should give you cash. If you ask equity shares, I should issue equity shares. Now based on this, you tell me, how should I treat the principal amount? Equity or liability? If you people ask equity shares, I have to issue equity shares. If you ask cash, I have to pay you cash. How will I treat this? Financial liability. Why? What is the definition of financial liability studied? Contractual obligation to deliver cash or financial assets to another party. Look at this here. I do not know whether you will ask cash or whether you ask shares. I do not know that. I should not sit and estimate and all. Our dreaming is not allowed. But in case if you ask cash, can I say no? No, I can't say that. That means I have an obligation to pay cash. I am not saying we will pay cash. We are having an expectation that we will pay cash. It's like a cheap language you should not use. If that fellow asks, can I say no? No, I can't say. That means undeniable situation, you have to pay cash. That is called as obligation to pay cash. Ultimately, that fellow may not ask also. That's a different thing. But if he asks, I can't say no. Therefore, there is a obligation to pay cash. Therefore, the standard says the principal amount is treated as a financial liability. Second case. This time I issued debentures, raised money, interest is mandatory, but after 5 years, whether I will pay you 10 lakh rupees cash or I will issue 1 lakh equity shares, a decision I will take. Tell me, do I have an obligation to pay cash? No. If you came to me after 5 years, company, we want cash only. Can I say no? Yes. If I can say no, that means that I don't have an obligation to pay cash. When you do not have an obligation to pay cash, how can you call it as a financial liability? You should not call it as a financial liability. So here, the principal amount, whatever you have, that is to be classified as equity component. This story is simple. Questions are simple point. Examine the entire facts of the case. Ask yourself, are we having an obligation to pay if the other fellow asks? If the answer is yes, financial liability. If the answer is no, equity. As simple as that. Are we clear here? Accounting will see later. Don't worry. Look at this chart once again. You should get a doubt. If you don't get a doubt, then something is wrong. And in fact, I will get a doubt on what I am teaching or what you are thinking. So think, Maryadaga, correct doubt, ask. See, watch carefully. A chart low, something is very misleading and you should be able to catch that if you are thinking really. Look at second case. Principal amount is equity. But what did I say? Interest or dividend is mandatory. You have an obligation to pay interest, but not an obligation to pay principal. Therefore, this portion is equity, this portion is financial liability. Overall, this is a CFI. Case 2, the problem not there. Come to case 1. This is mandatory interest, financial liability. Principal, you have an obligation to pay cash. This also I am calling it as a financial liability. So, overall, also it should become financial liability. But we are discussing compound financial instrument. It is still a CFI only. How? That's the doubt you should ask. You are asking me about accounting. I told you, no, accounting is not the subject matter of 32. When I tell you accounting, it will be just like cutting a cake. The smooth accounting, sir. The difficult part is 32 only. This is exactly what people don't teach, what students don't study. Stupid accounting, staff loan accounting, CFI accounting, very cheap, sir. One proper good sum you hit, 10 sums are similar only. You'll get, everything will get kicked off. Just like cutting a cake. Anta smooth ఉంటుంది 109. Difficulty is in 32 only. ఇది ఎంత బాగా వస్తే 109, that much smoothly it will be done. So we are investing time, not wasting time. So tell me, why is it overall a CFI? No, that's not the answer. I'll try to tell you something, the logic. If you understand, beautiful. If you don't understand also, very beautiful. Okay, don't pay too much attention. Anyway, after doing sums, you will not get a doubt. Means doubt, E-doubt will not be clarified, but doubt either will not come. But I'll try to clarify to the best of my ability. You try and understand. The important stuff, sir. Because some of the explanations given by ICA in the answers, you won't get it. Otherwise, no investment on this time. Anyway, let's see. Sir, there is a company called A Limited. A Limited went to bank. Asked the bank, bank, I want 100 crores loan. I will repay after 5 years. Bank looked at your face very keenly. They are looking like that for 20 days. Every day looking at A Limited face only. Face means financial statements, past history, your credit rating. Looking at all this, bank told, array, for the risk what you have, we need a required return of 14%. Who wants a return of 14%? Bank. You are risky fellow. You are not government of India, no, to give you money at 4%. You are private company. Last 5 years, so 1 or 2 defaults also you made. Some loans you paid correctly on time. So overall, I feel that you are a risky customer. For giving money to you, you should pay us an interest of 14%. So the required return from A Limited, anybody will expect. Now we'll give you cases, try to understand, answer automatically will come. Case 1, forget about bank now, that's over, that's a different example. A Limited issued 14% redeemable debentures for 100 crores at par. What is the meaning of this, sir? Redeemable means what? Today I receive 100 crores. I pay interest. One day I will pay 100 crores back. There is no conversion option and all. So that fellow who gave me this money, he will get how much return every year? He will get exactly 14%, nothing more, nothing less. And what is the required return from my company? That is also 14%. So the investor is exactly getting what he is supposed to get, nothing more, nothing less. This is a case. This is plain vanilla case. In this, doubt will not come. Case 2 lo doubt or clarity both will come. A Limited issued 12% compulsory convertible debentures at rupees 100 crores at par. Ultimately, one lakh shares issued at year 4. In case 2 also, I raised same 100 crores on the market, but I am not paying interest of 14. I am paying interest of only 12%. Now the question is, which stupid gave you money by accepting a return of only 12%? Will anybody give a? For my face, nobody will lend me money without expecting a return of 14%. But some people gave me only at 12%. Why did he give? What is the logic behind that? Because you promised them not repayment of cash, you promised them issue of shares. Those fellows who gave you money, sir, what their feeling is, from this fellow we have to take at least 14%. He is anyway promising how much? 12. 12 anyway we will get. But every year I am losing how much? 2%. Whatever I am losing every year, that these people are expecting it to get it recovered by the value of shares what they are getting at the end of year 4. Today if they are giving me 100 crores, what they are feeling is, after 4th year, when we receive 1 lakh shares, this 1 lakh shares ka worth will be more than 100 crores in such a way that I extra amount value will compensate me for all the interest loss in year 1, year 2, year 3, year 4. If those buggers don't have this feeling, why will they accept 12% return? Are you understanding? So if somebody is giving you money at a lower interest rate, interest loss how will he recover? He is recovering or he is expecting to recover through your equity shares. Think from company's point of view. Is the company showing its equity instrument, which is equity share, and reducing the burden on P&L account? Are you avoiding some cash flow each year by showing your equity share? That is the equity component here. You showed your equity share and you are avoiding any cash payment. Look at third case, even more deep. A Limited issued 10% debentures for rupees 100 crores, which are redeemable or convertible at year 4 at option of holder. Tell me, sir, for my face, the other fellow should ask me interest of how much? 14%. But this fellow is asking how much? 10%. And he gave me full 100 crores also. Why did he give for only 10%? He's a fool, huh? No. A 4% whatever he is losing, how is he trying to recover? There are two ways or two reasons why he gave us at a lower interest rate. Reason is, one thing, did you display your shares here? Yes. Not only that, you also gave a choice to that fellow. Tell me, sir, options are free, huh? Options are not free. Now here, who is having the option? Holder. Whenever somebody has the option, he has to pay premium to the other party. Here, what is that premium, you know? Accepting a lower interest rate itself is the premium for getting a option. Actually, I have to pay you 14%, but I am paying you only 10%. If 4%, whatever I am not paying you because of two reasons. One, I am displaying my share. Looking at that, you said, okay, sir, 12% also okay. Then I tell you that, Babu, if you want, I'll give you an option also. Okay, sir, 10% also okay. That means I avoided some cash flow payment by displaying my equity shares and giving you a option. That is how an equity element creeps into the picture. Apparently, how it appears is, interest to mandatorily you have to pay financial liability. Principally, you have an obligation to pay financial liability. Where is equity component? Equity component comes here. Mandatorily you have to pay, but what you are paying is less. Actually, you have to pay 14, but you are paying only 10. If 4% what you are not paying, that is because you used a equity share in the picture. That is how equity element comes into the game. Therefore, it becomes a CFI. Understand the logic, sir? Because apparently for our eyes, what is visible is, idi mandatory, ikkada obligation is there, idi financial liability, where is equity? Equity is there here. The mandatory cash outflow what you pay, adi lesser than what it should have been. Why is it lesser? You used equity share in the game. That's how equity element comes into the picture. Or you give an option. So guys, this is your story on F2F test and compound financial instruments. Contingent settlement provisions, the third one, very cheap. On this one example also is not there. What is this is? Sir, I enter into a contract with you. I will tell you that after 5 years, either I will issue equity shares or I will pay you cash, depending on whether market price is more than 500 or not. If market price is more than 500 rupees, I will pay cash. If it is less than 500, I will issue 1 lakh shares. So whether market price of the share will be crossing 500 or not, how will I know today? I do not know. So how will I settle it? Either by shares or by cash, which is not wholly in my control or in fact anybody's control. These are called as contingent settlement provisions. What is contingent here? The mode of settlement is contingent. What our standard says is account it as a financial liability. Sir, why not equity? Because ultimately equity shares also can be issued. No, true. For this, the logic comes like this. If you classify this as equity, as equity shares, what is the accounting, you tell me? Normal equity shares, what is the accounting? First time, you will account it as bank account debit to share capital. Thereafter, every year, is there any accounting? No. Like how equity share capital is accounted only once in a lifetime, every equity instrument ka accounting only once. First time you record and you leave it like that. You will not do any subsequent accounting for that. Contingent settlement provisions, sir, after 5 years, whether I will issue shares or whether I will pay cash, I do not know. If today you classify it as an equity instrument, next 5 years this fellow will not do any accounting apart from initial recognition. So on a safe side, to make you account for this for all 5 years, they ask you to account it as a financial liability. On this example, question, nothing is there. The standard 11 point, so I also brought. Study matter discussion is also not there on this. Anyway, these 3 are over. The next 3 are cases where our entity will receive our own equity shares back from the holder. The other party, some other party is delivering us our own equity shares. In this first case, is buyback. Tell me, sir, what is the entry when you buy back shares? Don't tell me share bought back account debit to bank, not all that. Overall gross entry. You paid money, bought your own shares, cancelled it off. What is the entry? Equity share capital account debit. That's for cancelling the equity shares. Entry amount is passed at what value? Face value or nominal value. To bank I am paying. This is your buyback price. Entry will tally or will not tally? Will not tally. There is a gap. What is this? Premium on redemption or premium on buyback? This premium on buyback, where did you adjust in your C enter? First priority lo used to search is a securities premium. You'll knock it off there. Ledu. Next. Capital reserve, general reserve, P&L account balance. Like that you use. E standard says debit it against your other equity. Other equity lo, who are there? Who are there? All your reserves are there. Your retained earnings, general reserve, capital reserve, securities premium, they are all there in your other equity. What India's 32 says is, in the event of a buyback, entire amount should be debited to equity. Entire amount, why will I debit to equity, sir? This is good equity, sir. This is also part of equity. This is also part of equity, no? Only thing is, this is called as share capital, this is called as other equity. But entire buyback price is ultimately debited to where? Equity and a heading only. Indirectly, what they are trying to say is, don't bring anything to PRL. Any gain or loss in relation to equity instruments should not enter into your P&L account. It should be merged directly in your reserves itself. So, are they accounting for this? Very, very easy case. There is another case, sir. On this, subject to time, I will tell you later on. This example is there, but they have removed this from study material in the recent updation of study mat. In new syllabus FR lo, e particular example, they have removed it from your study material. When they remove it without giving reason, there can be two possibilities. One, it's important they removed, it will come off in the exam. Or there are some flaws in this example, therefore they have removed it. So, anyway, just casually we'll discuss. Follow the example correctly. Okay, first answer this. Sir, there is an equity share capital whose face value is 10. Market price is let us say 50. Today I announced a buyback, under which buyback price I offered is 60. What is the 60 is again confusing. Let me 70. You tell me what is the entry for buyback I should write. Equity share capital account debit 10. To bank is 70. 60 rupees you have to debit it to other equity. Other retained earnings are securities, depending on your availability, you use whatever reserve you want, but ultimately this is the entry. Are we clear here? Right? I'll tell you a case. I'll go on solving, you understand. If you understand, that's enough. Our example is removed from the study material, but as such in our class material, I have given the entries for this also. Because it is there, it was there in the study material list. So, this E point is that entries for all this. Okay? You watch here, you will understand. Tell me, sir, what is the meaning of put option? Tell me, what should come in your mind when you right to sell? Right to sell, who has? Holder. Now, in this story, entity writes put option on its own shares. Tell me, sir. Now, entity is writer or holder? Writer. Who is the holder? Other party. Other party, if he has a right to sell our own shares back to us, from our point of view, what do we have? Obligation to buy. Obligation to buy. Are you understanding, sir? It is indirectly a buyback of shares that will happen on a future date if the other party decides to exercise his put option. Let us give you some data. Face value of the share 10 rupees or else 100 rupees. Exercise price in put option, let us say, is 130. Premium received. Why will you receive premium? We wrote the option, the other fellow is purchasing the option, he will pay 5 rupees to us premium. Maturity period, when he can exercise the option, is 1 year from today. Consider a discounting rate of 10% also. This is data given to you. For this, accounting has to be done, sir. This is buyback only, but it is not a buyback now. It's a buyback at a later date if the other fellow decides to exercise the put option. Are you understanding, sir? If he exercises the put option, then I have to comply and I have to compulsorily buy back my own shares. Now, before I go deep into the accounting, tell me only one point, sir. What is the exercise price you have promised? Exercise price, not face value. 130. Either we have to pay or we will receive. We have to pay. Did I receive anything from the holder today? Premium. How much is that? 5 rupees. So effectively the buyback price is indirectly. Indirectly the buyback price is 125. What is the face value of the share? 100. So extra amount paid over and above the face value is 25. This is the amount that should go into your retained earnings or other equity, isn't it? Hold on through this chart correctly, then the entries will fall in the correct way. Otherwise, last confusion will come. Anyway, first entry is you received money on day 1. You don't have a choice, you have to debit bank account 5 rupees. Whatever amount you receive, since it's related to your own equity shares, directly credit this to your retained earnings. The other equity retained earnings means 5. But by accepting this 5 rupees, are you having an obligation to buy back your own shares? Yes. Since you have an obligation to buy back your own shares, by paying money, you have to create a financial liability. Tell me, sir, to that customer or to the holder, how much amount we have to pay after 1 year? 130. But since it is after 1 year, there is a time value of money involved. Instead of recognizing at 130, recognize at present value of 130. 130 divided by 1 plus 0.10 whole power 1. ఎంత వచ్చిందమ్మా? 118. Leave it. Chiller, you leave it. So 118. Question is, where should I debit? Guess and tell me. You are creating a liability. Debit should be given to whom? Where? To whom are you paying this money? To whom you are paying this money? That fellow who brings to you your own equity shares, isn't it? That means that fellow is an equity shareholder only ultimately. So if any equity participant you pay money, what did I tell you? You are not supposed to use a P&L account. So this is something which has to be adjusted through retained earnings only. 118. First day ka accounting over. Now at year 1. Without much of thought, first and foremost thing what you have to do is, since financial liability is recognized at present value, first to go and do unwinding of discount. So interest cost account debit to financial liability, 12 rupees, 12 rupees. That's nothing but 118 into 10% rounded up, don't worry. Now after writing this entry, my financial liability account will appear at 130. Hereafter two possibilities exist. Possibility 1, holder exercises the put. If he exercises the put, tell me, sir, physically what should happen? That fellow should bring us back our share and we should pay him an amount of 130. Since you have to pay to bank 130. Debit what? You created a financial liability for this purpose only, no sir? Use this. Sir, but our share came back to us. Yes, cancel that share. Equity share, capital account debit, 10 rupees face value. 10 kada? 100, 100. Credit where? Why retained earnings? Retained earnings. Why should we credit retained earnings? Important stuff, correctly understand. These small points, sir, but mistakes will happen. Okay, retained earnings is right. But why? What we understand is, whenever a buyback transaction happens, entire buyback price should not be debited to retained earnings. Only the premium portion should be debited to retained earnings. Face value should be debited to whom? Equity share capital. E particular example, how much is the effective buyback price? 125. In this, equity should be, share capital should be debited with 100. Retained earnings should be debited with 25. But what did you do? Count till now. Retained earnings, how much did you credit here? Credited 5. Later on you debited 118. That means effective debit is 113. After that, interest cost, when you book it in P&L account, that will ultimately impact retained earnings only. Retained earnings are further debited by 12, which means 125. Entire buyback price got debited to retained earnings. But retained earnings, you should debit only the premium portion, not the face value. So since you extra debited retained earnings already, put it back to your retained earnings. 100. Game over. Effectively, if you observe, only 25 rupees got debited to retained earnings, which is nothing but the effective premium paid on buyback. This when, sir, when the option gets exercised. If the holder lapses the put option, then you need not pay that financial liability 130 to him. Cancel it. Entire amount will be transferred to your returns. Shares are not bought back. Shares are there with shareholder only. It unnecessarily created. The money also again adjust it into your returns. Khatam, game over. This one very good case. What they did is they gave an example. A example of a narrative formula they wrote without writing one entry also. Full of 2 paragraphs they wrote. A paragraphs ki is entry format which I gave so that easy to remember. Just recently they removed it in the latest study mat, but as such this is not a bad provision. Finally, last aspect is treasury shares. Okay. Treasury shares means an entity buys its own shares from the market and holds them without cancelling them. That is called as treasury shares. In India, this is not permitted because when you buy back your own shares, you have to compulsorily cancel them. But in case in any country if it is permitted, what our standard says is, whatever shares you bought back which are there in your own hands, that is your own company shares, don't account it as an investment and show it as a financial asset. But you don't have a choice other than writing this, no. Suppose you bought back your own shares in the market for 1000 rupees. To bank anyway you have to write. What I am telling is, don't show it as a investment. Now you tell me, sir, what choice do I have? If you debit equity share capital, that will give a feeling as if you are cancelling the shares. I am not cancelling the shares. Shares are there with me only, no. I am holding the shares but not cancelling the shares. So it's not appropriate to call it as, to direct debit it to equity share capital. You can debit it to your retained earnings. But in the notes to accounts and all, detailedly you have to write disclosures. We are having total 1 lakh shares. In this 100 shares we ourselves are holding. So with outsiders only 99,900 shares are there. In notes to accounts you have to give all this. But accounting is this. Sir, then why did you buy the shares? Trading key. After few months I sold it off for 1500. What is the entry? Bank account debit to retained earnings. How much is profit on sale? 500. 500 automatically gets accounted under retained earnings. You need not do anything for that. All you have to do is retained earnings to bank, bank to retained earnings. Sir, this entry and nobody told me also. What they told is adjust it through equity and the guidance given in the standard. What is the meaning of equity? Equity means equity share capital and other equity. So when you buy back your own shares and you are holding it as an investment, you should debit either equity share capital or other equity. I feel other equity is more appropriate, so I wrote that entry. But on these questions are not there, discussions are not there, nowhere it is there. Nobody bothers because India this is not applicable. Okay, but this is the principle. If I write an entry, you'll remember the concept and I wrote. There is no big deal. There is no questions also on that. Sir, with this, what we have finished off is all the contracts which are going to be settled by issue of own equity shares, that done. Okay guys, with this, these points are over. Now let's come to few more aspects here. Quickly we'll finish up. Sir, up to here the dry theory part is over. Here onwards accounting part. Now he's teaching us how to account for transaction cost. Transaction cost means, suppose you are buying shares in stock market. When you are buying shares on an exchange, you have to pay some brokerage, STT tax and all. Incidental expenses whatever are there, they are called as transaction cost. Similarly, when you sell shares also, transaction cost you have to incur. If you are raising debentures, you have to pay expenses, underwriting commission you have to pay, stamp duty you have to pay. All these are transaction cost. You are issuing equity shares, you appointed an underwriter, underwriting commission you have to pay. All these are transaction cost. So at the time of raising money or at the time of investing money, if you incur any incidental preliminary expenses, they are called as transaction cost. What is the treatment of transaction cost? Now, standard says any transaction cost that is incurred in relation to issue of equity instruments should be adjusted in equity itself. What is the meaning of this is, I am issuing equity shares. I appointed an underwriter. To that fellow I paid underwriting commission. Now underwriting commission, since it is related to issue of equity instrument, the underwriting commission cannot come into your PRL. It has to be adjusted into balance sheet itself. Balance sheet where? Other equity low, retained earnings is there, general reserve is there, securities premium is there, knock it off there. Don't bring this underwriting commission to P&L account. Sir, underwriting commission will never come to P&L account. Sir, I did not say that. What I told, underwriting commission paid on issue of equity shares will not come. Suppose you are issuing redeemable debentures, which is a financial liability. Underwriting commission you paid, that fellow will come into P&L account. So the treatment is not given for underwriting commission, treatment is given for the instrument. If it is an equity instrument, all transaction costs should not come into P&L account, adjust in the balance sheet itself in other equity. Are you understanding, sir? Now, India's 32 guidance, you see how funny it is. He says, any transaction cost related to issue of equity instruments are directly adjusted into equity. Sir, what about transaction cost incurred in relation to purchase of financial assets or raising some other financial liabilities? What about that? He says, refer India's 109. Not covered here. Transaction cost accounting not covered in 32 completely, partially covered. So remaining part, just in 15 minutes we'll start, then we'll see. Transaction cost relating to financial assets, financial liability depends on the method of accounting you are applying for that. But equity instruments, clarity is there. You issue equity shares, you issue any other pure equity instrument like a irredeemable debenture with a discretionary dividend and all, will not go to P&L account after adjust in the balance sheet itself. Then we know. After that, something is written in bold. That is very, very important. In fact, that is the only line given in this entire standard for equity instruments accounting. Read that. Any contract or instrument, if classified as equity, it will be measured only at its initial value and there would be no subsequent remeasurement. Ante sir. Hereafter, standard will not talk anything about equity. After so much of discussion on equity definition, equity versus financial liability, ultimately if you call something as equity, okate line, what is that? First time you record something, no, shut up after that, don't do anything. Sir, for this easily how you remember is, imagine I issued equity shares today. Face value 100, I issued at 120. So 20 rupees is securities premium. 1 year is over. Market low, our own share price today is 160. 160. This fellow is thinking like this. Last year shares we issued at 120, 100 share capital I wrote, 20 securities premium I wrote, but today's share value is 160, 40 rupees it has increased. If 40 rupees I will fair value my own equity share capital. Not allowed. Not allowed. You cannot fair value your own equity instruments. Sir, you only told no sir, NDS is obsessed with fair value. Does not mean that your own equity share capital will fair value. Sir, why fair valuation is not permitted for our own equity instruments? Tell me sir, why did 120 price increase to 160 in the market? What could be the reason? Tell me, don't tell me cheap reasons. Sir, Modi became PM, not like this. Proper reason, genuine reason, theoretical, fundamentally strong reasons. we earned profits, our performance is good, share price increased. If that is the reason, our profit is already there in your other equity only, no? If market share price has increased because of our wonderful performance in the first year, our wonderful performance is there in your P&L account and it already came into your other equity. Retained earnings are already accounted. Again, if you fair value, are you not double accounting that? Next, second thing. You may say, sir, profit nominal only, but our company assets value has crazily increased. If assets value crazily increased, go and revalue the assets. No, revaluation choice is there. PP it is there. India's 38 it is there. All investments are generally measured at fair value only. So when you fair value, what will happen? Our fair value gains will either come into your PRL or will come into your OCI. They will anyway come into your other equity. They are already accounted. Don't touch them. So the share price increasing ki rende reasons. Either your performance should be good or your net assets ka value should increase. Both are anyway accounted in your financial statements. That's why you should not go and separately fair value your own equity instruments again. Suppose I am X Limited, manufacturing company. I am having surplus money. I invested this money in Infosys company shares. This is my financial asset. This I can fair value. Other company ka equity shares which are my assets, I can fair value. But my own company ka equity share capital is my own equity. That cannot be fair valued. That is a sin. Even thinking about fair valuing your own equity is wrong. Very, very powerful points are. Later on, E point if you are not strong, E standalone nothing will happen. Share based payments and mistakes will happen. Means thought will not sit properly. Why you should not fair value your own equity? Ide reason. Yokate line, but very important. Come to interest rate dividends. Let's see. Don't read the chart. Think and tell me. Based on your past experience. You purchase investment in shares. Our company declared dividend. Dividend is your income. Income will come where? PRL, OCI, retained earnings. Dividend income, sir. P&L account format you remember. Revenue from operations over. After that other income is there. That is where interest income, dividend income will sit there. Similarly, you have a borrowing. On that borrowing, you paid interest. Interest expense will come where? PRL, OCI, retained earnings are where? PRL. So, moral of the story, interest and dividend income, PRL. Interest expense, PRL. On your equity shares, you declared dividends. Where will it come? You paid dividend to your equity shareholders by where will it come? What is the entry for dividend paid? Tell me. Dividend to bank. A dividend account, what will you do? You have to adjust it to your retained earnings. Actually, the entry is retained earnings account debit to dividend payable account debit to bank. Effective entry comes to retained earnings to bank. Whatever you pay to equity shareholders, that is not an expense to be recorded in PRL. That is their money, they are taking it out. So directly balance sheet, you have to write the entry. Retained earnings account debit to bank. Moral of the story, interest and dividend relating to financial assets, PRL. Interest and dividend relating to financial liabilities, PRL. Interest or dividend related to equity instruments, retained earnings. Why did you say interest, sir? Equity instruments means dividend, no. Arey sir, legally name is dividend. These stupid people in contract, they can write anything, no. For example, I issued redeemable debentures with a discretionary interest. Redeemable debenture. So debenture is a financial liability. Interest not mandatory. If I want, I will pay. Otherwise, I will not pay. Suppose in this case, I paid. Just because the basic classification is financial liability, interest will not go to PRL. The discretionary payment. Discretionary payment is just like normal dividend on equity shares. Normal dividend on equity shares, what will you do? Retained earnings you adjust. Here also you have to adjust it to retained earnings only. So very important points are what I just now told you. You have a redeemable debentures. Principal pakka you have to repay after 5 years. But next 5 years interest, whether I will pay or not pay, that's my choice. Suppose I paid. How will you treat this interest? PRL, retained earnings, retained earnings. All discretionary payments, retained earnings. Obligation to pay kind of payments, PRL. Suppose preference shares are there, redeemable. I told mandatory dividend. Name dividend, but not discretionary. Mandatory. The moment you put the word mandatory, it takes the shape of interest. Will come to your PR. Are you understanding? Just understand the facts correctly and answer. Okay. For this entire discussion, one exception is there. Interest on a borrowing will not come to PRL, but get capitalized to the cost of the asset. Borrowing cost capitalization is permitted in AS 23. If some other Indias asks you to get out from PRL, you will get out. Otherwise, you will stay in PRL. All interest, all dividend, answer is PRL, except on equity instruments and discretionary payments. They are adjusted directly into retained earnings. 11th point, I need not tell you, already discussed. Offsetting financial asset and financial liability. I have a debtor, I have a creditor, both are represented by the same party. Can I present them on a net basis? Ind AS 32 says the answer is yes, provided it is legally permissible and you have intention to settle it on a net basis. For example, I took a loan from ICICI Bank, I owe them 100 crores. I also purchased investment in equity shares of ICICI 10 crores. Investment also in ICICI Bank, loan is also from ICICI Bank. Tell me, sir, can I present them on net basis? Is it legally permissible? No, don't do that. Just because parties are same, automatically you should not assume a right of offsetting. That is wrong. Fine. Puttable financial instruments, last we will see. FCCB, the carve out point, sir. Never came, but you never know. Listen here, simple point. Sir, FCCB, what is the meaning of CB? Convertible bond. FC? Foreign currency. Imagine I issued a bond in USA. I'm an Indian fellow, but I raised money by issuing bond in USA. Imagine face value is $1. E-bond, ultimately I will not repay in cash. I will convert them into equity shares. Now, if I tell you that one bond is convertible into 5 shares. Tell me, number of shares to be issued is fixed or variable? Sir, clear, sir. Each bond is convertible into 5 shares. Tell me, is it fixed or variable? Fixed. FTF test definitely will be passed because money is already received. Number of shares to be issued is fixed. Pakka equity instrument, no doubt. Look at second case. One bond is convertible into equity shares at issue price of 20 cents or $0.20. ఇప్పుడు number of shares ఫిక్స్ చేయలేదు సార్, కానీ ఇష్యూ ప్రైస్ ఫిక్స్ చేశాం. ఫిక్స్డ్ ఆర్ వేరియబుల్? ఫిక్స్డ్. How fixed? Tell me. Number of shares to be issued, if I go sit and calculate, what is the face value of the bond? $1. What is the share issue price? $0.20. Ultimately I have to issue. From this, what is the conclusion? Whenever issue price is fixed, it is as good as number of shares to be issued also is fixed. In this FTF test definitely will be passed. I'll show you one case where issue price is fixed but number of shares is variable. Same drama. Good. Somebody guessed it rightly. Into equity shares at issue price of ₹20. What's the difference between second case and the third case? Second case where issue price is there in foreign currency. Third case where issue price is there in Indian rupee, functional currency of the entity. Tell me now, how to decide the number of shares? One problem you will face. Face value $1. You have to divide it with ₹20. How can you divide? You have to do something else now. What is that? Convert this dollar into rupees. Which rate will you apply? Exchange rate on date of conversion. spot rate on the date of conversion, correct. Depending on that rate, number of shares will change or not. Today conversion is after 5 years, sir. After 5 years, what exchange rate will prevail? Do I know today? I do not know. If exchange rate here is $1 into rupees 60 per dollar, 20. Ultimately, I have to issue 3 shares. If it is rupees 80 per dollar, then I have to issue 4 shares. If it is 120 rupees per dollar, then I have to issue 6 shares. So tell me, number of shares is fixed or variable? Variable. But second case law, I fixed the issue price. Third case law also, I fixed the issue price. Irrespective of market price, my issue price is already fixed. Nevertheless, the number of shares is still coming as variable. Why is it coming variable now? Is it because I am trying to protect the return of the other fellow? I am giving more shares because I want to get him some desired return? No, that is not the reason here. The reason for variability is what? Exchange rate fluctuation. Because of that, variability is naturally coming as the inherent nature of the instrument. Now we are studying Ind AS 32. Then the parallel standard is IAS 32. IAS 32 says F2F test is failed since number of shares is variable. Therefore, this is classified as a financial liability. India law, we took an exception for this. We said that issue price you have fixed means you don't have any intention to protect the return of the other party. Sir, why should I fix issue price? Can't I simply say after 5 years whatever market price of my share is that you take, am I taking that? No, I am fixing an issue price, just like case 2. My goal is to issue fixed shares only, but I cannot issue fixed number of shares because the issue price of the share is fixed in local currency, but foreign currency bond ka value is in obviously foreign currency. So exchange rate will play a role which is not in my control. So variability entering into our contract is the inherent nature of the instrument, not that I want to issue variable number of shares. If only I wanted to issue variable number of shares, I would not have fixed the issue price. I would have simply said that at market price at year 5 and I would have told. I did not say that. So in India, we took an exception for this. We classified this as an equity instrument. Since you went against IAS, this is a carve out. What do you feel, sir? Indian argument is right or wrong? Right. Because my intention is never to protect the return of the instrument holder. I want to issue fixed number of shares only, but unfortunately this is becoming variable because of exchange rate fluctuation. So Indian argument is right. But off the record, do you think suddenly Indians become that smart? Why did you go something beyond, beautifully beyond IAS, IFRS, and you came out with some top-notch provision which is sounding logical also? And internationally, evadiki an idea, why our people only got this idea? What could be the reason? Maybe somebody suffered because of this very badly. That fellow reported to ICA, Reliance Industries. That fellow has the biggest amount of borrowing in the form of convertible bonds for FCCBs. Billions he raised, billions. If you apply IAS 32, the entire FCCB is to be treated as financial liability. The moment you call it as financial liability, India's 21 foreign exchange standard law, it will become a monetary item. If you become a monetary item, on every balance sheet date, you have to remeasure the financial liability applying the closing spot rate, and that entire gap is an exchange gain or loss in your P&L account. And thanks to our Indian way of managing economy, exchange rate has crossed around 82, 83 now. No mood to come down. We people don't have shame. It was 70, sir. It is now 83 plus. Every year, next year it will be 85, don't worry. It keeps on increasing. When exchange rate keeps on increasing, you have a foreign currency loan liability, what will happen? Liability value also increases. Huge loss will keep on hitting your P&L account. Our Reliance ka profit, the exchange loss is eating away. What this fellow went to IC and told is, Are Babu, I fixed the issue price already. Number of shares variable. But I am not going to pay cash for sure. I am going to issue number of shares only. The variable because of exchange rate fluctuation. I already fixed the issue price. Few call this as a financial liability. My P&L is becoming a loss now because of this one particular item. And I don't have any intention to protect their returns. So call this as an equity. They classified it as equity. Now when they classify it as equity, since it is no more a liability, Ind AS 21 lo remeasurement concept will not apply for him. Equity kada, remeasure you should not do. Don't do. So exchange loss will never come in your P&L account. You are protected. Adi ee carve out ka importance. Whatever logic they told, logic correct logic. But why suddenly India lo inta force ga first lone they made this adjustment is because somebody reported this. Because of this international standard, we are already facing problems when we prepare financial statements under IFRS. At least when you prepare Ind AS, give us an exception. They found it logical, they gave exception. The carve out ka background. Why? You will not record at fair value of shares, face value. Don't think about accounting. 109. Sir, you are unnecessarily spoiling your mind thinking about what will happen when we account. Don't think that. You have to think when you have to think. 109. Now that 32 is over, here onwards we'll do that only. Sir, putable financial instruments is the last concept of Ind AS 32. This I will discuss later on, sir. Easy concept only. Only 3 or 4 theory questions are there. No accounting is given in anywhere. So just a theory only. Later on we'll discuss. Easy only, but it's a dry concept. That's all. Apart from this, Ind AS 32, nothing is there, sir, except for the scope exclusions. So there are certain items which may be financial asset, financial liability or equity instrument, but they are not covered in this standard. Sir, why are they not covered? Because some other standards are covering that. That's why. First one is the most important one. Remaining are all not very greatly important. We all know that investment in equity share is forming part of your financial asset definition. So every investment in equity share should be covered under instrument standard. But these three are not covered. Investment in equity shares of subsidiary, joint venture or associate are not in the scope of financial instruments standard. Even though that is investment in equity share, not covered. Sir, why not covered? Later on, once we start 109, you will understand that all investment in equity shares should be measured at FETPL or FETOCA, which means you have to fair value the shares. But subsidiary shares what I have, they are not held for selling in the market, no. They are held for controlling the company, or associate case lo exercising significant influence purpose we hold the shares. My goal is not to trade with those shares, but to exercise control on the other company. Since anyway my goal is not to sell the shares, what is the point of fair valuing the shares and bringing that gain to your P&L account when anyway you are not going to sell the shares? So E standard is not applicable for us. So then which standard is applicable? There is a standard called as separate financial statements, Ind AS 27. Later on we will say the one-page standard. Ind AS 27 covers investment in equity shares of subsidiary, associate, joint venture. In that Ind AS 27 separate financial statements, you know what is there? Entity will have two choices. Choice number 1, cost. Investment in equity shares, say you will show them at cost without doing any fair valuation, lifelong, only cost. This is option. Option number 2, you can follow Ind AS 109. 109 first asked you to get out. You went away from here. You went to Ind AS 27. 27 says, I'll give you gate pass if you want to go to 109, you can go. You can still do fair valuations if you want. But E point is not given in this standard, is given in Ind AS 27 standard. At 27 when it comes, at that time we will talk. The remaining examples are not very relevant for you. Means you go through, you understand, but you don't have any applications of that, so why to bother yourself? Next one. Sir, here onwards, it is recognition and measurement of financial instruments. This is your Ind AS 109. See the first chart given to you. Financial assets, sir, there are three possible methods. I am not saying three alternatives. Three methods are possible. Which one is to be applied? Not your wish. Standard will tell you. But overall, three methods say. One is amortized cost method, fair value through profit or loss, fair value through other comprehensive income. There is no fourth method. Any asset has to be accounted under either of these three. Which one we will see later on. For financial liabilities, you don't have three. You have only two methods. One is ACM, amortized cost method. The other one is FETPL. So which method is not there for liability? FET-OCA. So overall, if you observe, overall, there are only three methods. ACM, FETPL, FET-OCA. Only three methods. Asset all the three are applicable in different scenarios. Liabilities only two methods are applicable. When which method is to be applied for which asset, we will see in a while. Before we see and understand that logic, first we should know how each method works. And if you have to apply ACM, what rules you have to keep in mind? If you have to apply FETPL, what rules you have to keep in mind? FET-OCA, what rules you have to keep in mind? Your ground rules, if you are clear and you know how to apply, then why you should apply FET-OCA only for a particular asset? Why some assets you should apply ACM only, and in logics you will properly understand. Otherwise you end up by hearting. Study material India's original 109, what they have done is, they first told you which assets which method you have to apply. Later on they explain how to apply each method. If I discuss in that way, you have to first by heart a list of assets for which asset which method is applicable. Later on you will understand the rules. We'll do reverse way, it will sound very organic for you. First I'll tell you how to apply the methods. Then you will understand why a particular method only should be applied for a particular asset. That way it will be easy for you to handle. So our way is like this, sir. First we will learn all the three methods. Once you learn all the three methods, you effectively know how to account a financial asset or financial liability. What you will not be knowing is when to apply which method. That's the next discussion. That's 20 minutes it will be over. With that you will start the story of financial assets. In this, basic accounting is there. Some special cases are there which are very important. Then there is something called as impairment of financial assets. Then there is something called as derecognition of financial assets, reclassification of financial assets. With that, financial asset story is over. Then we'll come to financial liabilities. When to apply ACM, when to apply FETPL. With that, basic liability discussion is over. After this, in this, there is something called as a loan restructuring. You took a huge loan from the bank, you are in worst financial position now. Go fall on the feet of the bank, tell him that you cannot repay, do something. That fellow will modify the terms of the loan. How to do accounting, extremely important for exam, restructuring. Then there is most important one, compound financial instrument ka accounting, where equity plus liability ka mixed accounting will be there, extremely highly important. Once this financial asset, financial liability is over, then we have to discuss accounting for derivative. Understanding derivative is difficult for first timer, but accounting for derivative is extremely cheap, very simple, very extremely easy. Among entire 109, if at all is something is easy, that is derivative only. It is that simple. Understanding derivative will take time, but accounting derivative won't take time. After this, we have to discuss something called as embedded derivative. The concept is little deep, but we have to do it very patiently. Question hasn't been asked in the recent times. Highly important. Once this is over, then you have only one concept called as hedge accounting. Hedge accounting, real life law optional. It's not mandatory. 109 does not make it mandatory. But exam key, there's nothing like that, no? You got to prepare. But good news is one question also is not there in study material, RTPs and all. But IFRS 2 questions are there. One long back MTP lo, one wrong question is there. That also is there. All these three you have to cover. With that, our hedge accounting drama will be over. With that, instruments is over. Like that. Overall, the way is lengthy, but you will not find any difficulty, sir. It will be very smooth. Just understand the basic skills. It'll take one at a time. We'll finish it. Let's see how to apply. You need not write anything. Everything is there in the material. Sir, every point, every logic I speak, that is already there in the book. If you are writing that, you are writing for your own satisfaction. This I am telling because some people are not writing. Don't feel bad for not writing. Focus on watching. Sir, first method is amortized cost method. Tell me ma, ACM is applicable for assets or liabilities or both? Both. First rule is initial recognition. Initial recognition is done at fair value, adjusted with transaction cost. What is the meaning of this is, you purchase investment in the market for 100 rupees. You paid 2 rupees brokerage. 100 is the fair value. 2 rupees is the transaction cost. Initial recognition is done at 100 plus 2, 102. This is called as fair value adjusted with transaction cost. Oh, adjusted means addition. No. Look at next example. I raised money by issue of redeemable debentures 100 rupees. I paid underwriting commission 5 rupees. 100 rupees inflow, 5 rupees transaction cost outflow, net inflow is 95. Initial recognition of liability is done at 95. Adjusted does not mean addition or subtraction. If both are outflows, add. Both are inflows, add. One is outflow, one is inflow, net off. The adjustment ka meaning. Clear, sir? This is initial recognition. Second point. Interest income, if it is a financial asset. Interest expense will be there if it is a financial liability, is to be measured at effective interest rate. What is effective interest rate? In CA Inter Capital Budgeting chapter, you might have studied IRR. That IRR in this India's language we call it as EIR, effective interest rate. Why are you not calling it as IRR, sir? Why to do overaction by giving new name? When you say IRR, you are talking about internal rate of return. Return on a word is used only for assets, but I have to use a neutral word because the method is applicable for financial asset also, financial liability also. So instead of calling it as IRR, we call it as EIR, but matter is same only. No subsequent remeasurement or revaluation. So first day you recorded some value. Every year interest expense, interest income accounting will happen. Thereafter you will never go to market, bring the fair value, start remeasuring and all. Nothing you will do. ACM law, it's almost like a cost model only. You will never go to the market and bring latest fair values and all. This is ACM, sir. Next one. Fair value through profit or loss. FETPL. FETPL, look at the rules, it will be completely opposite in each step. Initial recognition in ACM was fair value with the transaction cost. Here, only fair value. Name a FETPL, no sir, everything will be at fair value. Sir, what will happen to transaction cost? Transaction cost will directly die in PRL. Interest, sorry, here simply write no EIR to be applied. You will not apply any effective interest rate concept. Whatever you receive as interest, that you will take it to P&L account. Whatever you pay as interest, that you will debit in P&L account. You will not sit and work out what is the effective cost of interest or effective rate of return and all. You will not work out that. No EIR. What is the third point? No subsequent revaluation is what we said in ACM, but this is not ACM, the fair value method. Compulsorily you have to fair value. Fair value the financial asset or financial liability on each balance sheet date. Definitely gain or loss will come. Where will it go? Name itself is FETPL. Where will it go? PRL it will go. That's all. Sir, ACM ki FETPL ki rules will be completely opposite. Now the last method, it's fair value through other comprehensive income. Initial recognition. What was ACM ki initial recognition principle? Fair value adjusted with transaction cost. FETPL ki only fair value. FETOCA ki it is like this. Fair value adjusted with transaction cost. Rather, I can say that ACM and FETOCA both are same as far as initial recognition is concerned. Interest income is to be measured at effective interest rate. In fact, amount should be same also as in ACM. If you apply ACM method, how much interest income will come each year? Ade interest income e method lo also you have to recognize as income. Effectively speaking, first point, second point are literally copy paste of ACM even in FETOC also. Third point obviously is different. Third point under ACM was what? No subsequent remeasurement. But here in the fair value method, compulsorily you have to fair value. Fair value financial asset on balance sheet date. Definitely gain or loss will come. This gain or loss you have to transfer to other comprehensive income. One reserve account you open and you transfer that. You will not transfer it to PRL. You transfer it to PRL, which method? FETPL. Anything you transfer it to PRL, that will become PAT, profit after tax. That will enter into retained earnings. You write anything in OCI, a separate account is created called as OCI reserve. It will come into the balance sheet. One day, when this financial asset itself is really sold, removed from your books, then OCI reserve, it may be reclassified or not reclassified. So such a stupid provision, how will you know whether it is reclassified or not? That we will see depending on the asset you have to decide. Not know. You just be open for a thought. OCI reserve is getting created. It can be recycled, cannot be recycled. In some cases are allowed, some cases are not allowed. Which case are not allowed, I will tell you later on. So the ground rules, sir. These rules, if you are strong, then accounting is half done, sir. So how you will remember this is, three aspects you have to remember. Initial recognition, interest accounting, subsequent measurement. Initial recognition is fair value with the transaction cost in ACM and also in FETOCA. If it is FETPL method, initial recognition is done only at fair value, transaction cost transfer to PRL. Interest income, interest expense is to be measured under EIR. Under which method? ACM. FETOCA interest income only will be there, expense will not be there because it is applicable only for financial assets. Therefore, EIR will be applied here also. But under FETPL, you will not apply anything called as EIR. Whatever actual cash flow is there year on year, that only will become your actual interest income or interest expense. Subsequent remeasurement is there in FETPL and FETOCA. ACM kit is not applicable. You are not supposed to do any fair valuation for ACM type assets or liabilities. That's all, sir. Over. Now, I kept some questions there. Just to save time, I gave these solved examples. So you need not write, but you should definitely learn this. If you don't learn this now, you'll face lot of problem while doing main questions. Just to save some half an hour, 40 minutes, 7, 8, 9 questions solutions I have printed. So I will do, you please do it on your calculator at least and observe this. A very critical number, sir. E question exam lo raadu, 100% raadu. But without this knowledge, other questions you cannot solve. Important stuff. Read. A Limited has issued 9% debentures of the face value 100 each, 5% discount. These debentures are redeemable after 3 years at par value. Show the accounting in the books of A Limited applying amortized cost method. Sir, if you issue debenture which is redeemable, is a liability or asset? Liability. Liability, how many methods are possible? 2 methods. Which method you have to apply, we have not discussed yet. But the question is directly telling you that go and apply ACM. Since you already learned the ground rules of ACM, based on that you can apply the method. The brackets will also read one small point. EIR is equal to 11.048%. Exam lo big questions they will give you, sir, except one or two questions where requirement itself is EIR. There you have to calculate EIR. Normal questions they will give you EIR. Okay. Now anyway, let's see what is this. Tell me, sir. First day you raised how much money? What's the face value of debenture? See fast. 100 rupees. But did you issue at 100? No. You issued at a discount. So money came is only 95. Debenture life is how much? 3 years. What's the coupon rate? 9. So on face value 100 rupees you have to pay 9% each year. So 9 rupees here, 9 rupees here, 9 rupees here. Lastly you have to also repay 100 rupees. So this is outflow, this is outflow, these two are also outflows. Effective interest rate means the discounting rate which equates the present value of your future cash outflows to initial recognition amount of 95. What is the discounting rate I should use so that 9 and 109 ka present value will become 95? That rate is called as effective interest rate. Now let's think like this. Hypothetically, imagine you issued the bond at par only until you received 100. Last law also you are paying 100. Every year you are paying how much? 999. So what is the cost of your borrowing? Very clearly 9%. But not in this case. Why not in this case? Because you issued the bond not at 100, 95. But you are paying 9 rupees every year, even though you received only 95 rupees. If you take your calculator, do 9 divided by 95 into 100. You won't get 9%, you'll get more than that. 9.4 or something you are getting. Not only that, first day you received 95 only, but climaxly you have to pay 100. If 5 rupees also you have to pay extra. That is additional burden on you. All put together, your cost is definitely more than 9%. Now, how much is my actual cost? Ade EIR. Sir, how will I know this? There is no way, sir. You have to only do trial and error. So, let's say, first trial, I do it 10%. Sir, how do you know that you should do it 10%? What I know is, my cost is more than 9%, I know. So, anything above 9% is good enough trial. I am trying at 10%. When you try at 10%, the present value of future cash flows won't come to 95. E trial fail outam, sir. Then second trial, let us say make it 12%. This time, my present value will go below 95. So then what I will conclude is, my 95 is somewhere in between 10 and 11. Then I start interpolating that. You know IRR formula? Don't know? Okay. Some people have not done AFM at all. So for those benefit. But you should tell me answers quickly. Tell me, sir. First trial, let's say I'll do it 10%. Present value of cash outflows. 9 into PVIFA 10% for 3 years and 100 into PVIF 10% of third period. So 9 into 2.48685 plus 100 into 0.75131. Sort out this. 97.5. But what is my goal? Present value should be how much for me? 95. Is it 95? Huh? No, it is 97. It should become 95 means I should increase the discounting rate further. So second trial, you can apply 12. You can apply 11.5 also. Let's apply 12. What is that? Nine into PVIFA 12% you should try now. It will be 2.4018 plus 100 into 7972 7118. 7118. Okay, do this. 92 point. This I want 95. This time I went below 95. So what's the moral of the story? Your answer is more than 10 but less than 12. Automatically 11 hours, sir. Okay, you have to interpolate here. Now how to do interpolation? Sir, if you remember IRR ka formula, you can apply that. But many people spoil that formula, don't apply. So look at this. Change low you do. At 10%, what's the present value you have? 97.5. At 12%, your change is 92.79. So for a 2% increase, your present value has decreased by 4.71. But from 97.5, I want to decrease, but not to 92, but to 95. So desired decrease is 2.5. Then 97.5 inch I should fall down to 95. If 2.5 rupees only I should fall down, this should be increased by how much? So cross multiply 2 into 2.5 divided by 4.71. Ento chinamma 1.10 1.06. Okay. So 1.06 is our final answer. No. My answer is 10%, but don't increase by 2%, but increase by 1.06%. So my desired EIR is lower rate plus this fraction 1.06%, which is 11.06%. This is called as interpolation technique. Anyway you should learn this, sir. AFM lo lot of applications are there. Even in instruments also, hereafter it will keep on coming. There are few questions where the requirement itself is you have to calculate this and give. 6 marks it came in the exam. 6 marks once it came in the exam. Study material is such a cunning fellow. You know what he did? He wrote all the cash flows. Last he wrote is equal to IRR brackets open, and final answer he wrote. What is that? Excel ka formula. Excel sheet lo IRR ka formula will be there. No? He applied that. He gave that only in the study material solution also. Exam he asked that question. How will you get Excel sheet? You don't. So you will do all this labor work there. But at least the answers, the numbers are small and cute. I mean 9 numbers are there which are ugly. They are not even equal. Annuity factor also you cannot apply there. Exam lo came 6 to 8, 6 marks to 8 marks it came once. But anyway, you should know how to handle. No? So this is the answer, sir. You ask me, sir, is accurate answer? No. Interpolation will never give you accurate answer. Suppose instead of 12, had you taken 11.5%, then also you will fail. But 10 ki 11.5 ki when you interpolate, no sir, the answer won't be 1.06, 1.05 or something like that. You will get. Adi, sir, this is a rounding of error into sir. This interpolation also has a flaw. What flaw is that? Is people have done with your AFM, it's something similar to your bond convexity. Okay, let me not talk on that. Okay, so interpolation also a flaw into sir. That's the reason you should never take huge gaps. Sir, let me do one thing. Why to take risk at 10 and 12? I'll take 2% first trial. Second trial 40%. Definitely it is between 2 and 40. No? At least the answer will be wrong, sir. Whatever flaw is there in this interpolation technique, a flaw gets magnified if the gap is high. Gap should be as small as possible. That's the matter, sir. Overaction indirectly. Anyway, now how to do the accounting? You will not do, you watch and you keep on telling me the numbers. Not from the answer. Sir, I raised bonds. What is entry? Bank account debit to debenture. So buy bank. How much did you raise? 95. Suppose this fellow tells you that you raised 95, but 2 rupees you paid transaction cost. The entry would have recorded only with 93. 95 inflow, 2 rupees outflow, effective inflow is 93. Directly 93k would have recorded because I am applying which method? ACM. First day accounting is over. How to account interest expense? What is the rule? What is the rule? ACM rule. EIR. What is EIR percentage? So, question they have given something, use that only. 11.06%. 0.048%. Apply and tell me. Calculator, see and tell what is their answer you tell. 10.49. That you keep. 10.5. Okay, fine. 10.5. This is the interest expense. How much you have to pay in the first year? Look at our chart. 9 rupees you have to pay. Now, what is interest is what is computed as per EIR, ade interest. What you are actually paying, that is not called as interest. That can be called as interest in your legal form, not in the eyes of Ind AS 109. Ind AS 109 we call that as contractual cash outflow. As per contract, how much is my cash flow? 9 rupees. But interest is not 9. Interest is 10.5. The entry what you will have to write is this. Interest expense account debit. How much is interest expense? 10.5. To financial liability 10.5. Okay, dummy entry you will pass like this. So here by interest expense 10.5. Of course, interest expense I will transfer it to P&L account. Profit and loss. How much I have to pay at the end of first year actually? 9 rupees. Pay that. To bank 9 rupees. Entry will not tally. Sorry, account will not tally. Closing balance will simply carry it forward to the next year. Sir, what is the fair value of debenture at the end of first year? That is not relevant for you because this is ACM. You are not supposed to do any fair valuations. Do you understand this entry? In this, what is important is entry A important. Hereafter, what will happen? Now, first year is over. Now, you are in second year. Buy balance brought forward 96.5. Come to end of second year. Again, write interest expense. How to write? In 96.5 into 11.048%. Tell me the answer, sir. 66. Second year ending, are you paying anything? Yes, to bank 9. Pay that. 16. 2 years is over. Now come to last year, final year. This is 98.16. Again, in the last year also, you have to record interest expense. 98.16 into 11.048%. Wait there. To bank, you have to pay 109. Once you pay 109, your obligation to deliver cash is completed. Hereafter, I don't have any more obligations. Since you don't have any more obligation, your account should be closed. And since interpolation of whatever number came, adi little approximated number, it is better you take last year ka interest as a balancing figure. So what's the answer? 10.4484. That's all. This is how you handle ACM method. Now, we have 3 rules, sir. These 3 rules I applied here. Initial recognition, fair value, transaction cost. Interest accounting at EIR, no subsequent remeasurement. All 3 I applied. But what you have to remember specifically is interest accounting entries are important. So what is the entry you are writing now? Interest expense account debit to financial liability. This entry is similar to interest accrued entry. Interest not paid, what is the entry? Still you have to book interest expense. Credit liability, it's exactly what I am doing. And whenever you pay, whether that is principal, whether that is interest, it does not matter. I will go and write only one entry. Financial liability to bank. In our basics, how we learnt is interest paid is interest paid to bank. Interest not paid is interest paid account, interest expense account debit to outstanding interest account. So what comes into our mind is interest paid will never come into liability account. Interest paid entry was what once upon a time? Interest to bank if you pay. If you don't pay, interest to interest payable. Will you touch that into debenture account? You will never use. But 1098 is not like that. Our accounting is wrong, sir. No, leave it, forget it. This is correct accounting. Let it be principal payment, let it be interest payment, let it be any payment. You will write only one entry. financial liability account debit to bank. Whatever interest expense you computed as per EIR, that you have to credit to liability. You may pay installment, only principal, only pay whatever you want. Pay by writing this entry. Interest expense ki the entry. Now you observe here. In any year, did the opening balance and closing balance matched? Match here. Match gala. Why? But first 95 rasaru sir. First year 96.5. It did not match. Why it did not match? Because the interest expense what you are recording and the contractual cash flow what you are paying, they both are not same. Since they both are not same, a difference between those two automatically gets adjusted into your closing balance. Will it happen in every sum like this? Suppose in any question, this and this both are matching, then your opening balance and closing balance ka number also will be same. In all the years it will be same. When your EIR rate and contractual cash flow rate both are same. Now, this particular sum, sir, imagine this is 100 rupees. You issued at par. You are redeeming at par. Your EIR also will be 9%. Contractual cash flow anyway at 9%. But what sir, account? Starting lo here you would have had 100. Here you would have had 9. Here you will pay 9. E number will be 100. Opening closing balances every year will be same. If opening balance closing balance every year should be same, coupon rate, the contractual rate, EIR both should be same. They both will be same if transaction costs are not there. If debentures are redeemable at par only, then they will be same. The question you say you will understand, sir, whether they are same or not same. But the observation is very powerful because later on we will be seeing a question like akkada debenture life 15 years. 8th year lo debenture ka modification will happen. Debenture ka modification 8th year if it is happening, asal what is the carrying amount of debenture you should know, no? The 8 years ka ledger kondestavu appudu. So you should know some technique to get that numbers. For that, in that sum what I will tell you is EIR, coupon rate both are same. If they both are same, initial recognition amount every year closing balance also. Without drawing any calculation, first day amount whatever is there, ade 8th year beginning amount also same ఉంటుంది sir. Observation if you know, there you can apply. With small point A, but very important point. Okay, look at this. Then there is something called as a ACM table. There are so many questions where they will not ask you to draft a ledger like this. They will say, prepare a ACM table and leave it. ACM table means, ide ledger, a table format you will prepare. Like, first year, second year, third year. Opening balance of financial liability. How much is that? 95. Add interest at the rate of 11.048%. You can tell me the numbers please. 10.5. Contractual cash flow paid 99109. This can't change. Closing balance 96.5. 96.8. Can I touch number? 66. This number 0.16. 98.16. This was 10.84. And this number should be 0. There are many questions where they ask you to just draft the ACM table. In that case, you will not do the stupid ledger account and waste your time. You will draft ACM and close it. ACM lo one beautiful observation is there. Correctly watch. Sir, do you accept that E 95 rupees is the present value of 99 and 109 discounted at 11.048%. Do you accept that? If it is not that, then that is not called as EIR. It has to match. Are you understanding, sir? It is okay. If you can understand. Look at this. When 95 is present value of 99109, then is 96.5 present value of 9 and 109? 95 is present value of 3 cash flows. So 96.5 should be present value of 2 cash flows. 98.6 should be present value of the last 109 alone. It will match. If you want, you can try and check. If it does not match, ACM account will never become 0 towards the end. it will never become 0. It has to match. That's the reason. What is powerful observation here is, when ACM is applied on any given day, on any day, the balance of financial asset or financial liability, as the case may be, will be equal to present value of future cash flows discounted at original EIR. So, this is very, very important, sir. Closing balance always will be equal to present value of future cash flows. Discounted at what rate? Not market rate and all. Original EIR. Again, similar case what I just now discussed with you. There is a 15 years bond. 9th year la modification is happening for that bond. I want to know what is the carrying amount of the bond at the beginning of year 9 or end of year 8. I want to know. Will you prepare 8 years ka ledger account? Time waste. Pony ACM table 2 years or 3 years will draw. 8 years, how will I draw? It will take lot of time. What is easy is 15 years life. 8 years already completed. Remaining life is how much? 7 years. 7 years ka cash flows discount it to 8th year. 9th year, 10th year, 11th year, 12th year, 13th year, 14th year, 15th year ka cash flows discount it to end of year 8. Whatever present value will come, that only will be the closing balance also. It is like in 96.5 is present value of this 9 and 109. So remaining cash flows you identify, discount it. That will take only one line. You just have to write that 9 into PVIFA 11.048% for 2 years plus 100 into PVIF 11.048% for second year. Calculation is say 96.5 will come off. The same time it will take even if the remaining period is 18 years also, no. So one line you can get the answer. You can avoid the entire ledger account. You can avoid the entire ACM table also. Calculation lo any given date ka carrying amount you can work out. The very important side, it will save lot of time. Acceptable for exam. Otherwise I am not telling you. Institute has done this. And time value if only you are supposed to be good because of your AFM subject in the same group at least. So anyway sir, this is the ACM technical rule. Now you will tell me based on this. Imagine I am doing a financial asset accounting under ACM. First day my entry will be what? Entry I am asking. Visualize and tell me. I bought a financial asset. Financial asset to bank. Amount at what value? Fair value plus transaction cost. Clear ma? Right. First year ending, I have to recognize interest income this time, not expense. Liability, what is the entry we wrote? Interest expense to liability and financial liability to bank. What will you write here? Financial asset account debit to interest income. And if you receive any contractual cash flows, bank account debit to financial asset. Automatically some closing balance will come. The next year you will use as a base for applying second year ka EIR. Like that life goes on. Rest all observations are same to same. Liability whatever observation is there, asset also same observation except for E entry ka change. The interest expense, this is an interest income. So that example also have kept here. Look at eighth sum. A Limited has advanced an amount of rupees 1 lakh to B Limited on 1/4/2015. It has collected processing charges of 10,000 on the same day from B Limited. This loan carries an interest rate of 10% and the loan is repayable after 3 years at a premium of 5%. Okay. Show the accounting in the books of A Limited for all the 3 years using ACM. The question itself is telling you apply ACM. Brackets, so he also tells you that EIR is equal to 15.87%. Tell me sir, A Limited took loan, gave loan? Gave loan. If you have given a loan, you have a contractual right to receive cash flow. Definitely it is a financial asset. Since they are asking you to apply ACM, apply ACM. But for applying ACM, I should know EIR. Luckily, EIR is also given to you. Now, if you plot the cash flows on the timeline, first day the loan what I gave is 1 lakh. but I collected processing charges అనే నేమ్తో ఒక 10,000 rupees. Effectively, my cash outflow is how much? 90,000. So even though legal contract law, the loan value is 1 lakh, India's 109 says that 1 lakh rupees you have given with right hand, left hand you collected 10,000 rupees. Effectively today you gave a loan of only 90,000. Accounting law loan given is only 90,000. Every year you will receive 10,000, 10,000, 10,000. Lastly you are receiving 1 lakh 5,000 also. So how much income are you making on a per annum basis on compounded calculation? That only we call it as EIR. They already gave you 15.87%. Look at the ledger posting, sir. First day, financial asset to bank 90,000. 1 lakh minus 10,000, effectively 90,000. Come to first year ending. First year ending, financial asset account debit to interest income amount. Take your 90,000, on that apply 15.87%. Some number will come, record that. Contractual cash flow, actually you are receiving only 10,000. Receive that. Closing balance is there 94,283. Like that, life goes on for the next 3 years. Last year what happens is, first write the full amount what you will receive. Interest income you will write it as a balance inflow. If you directly compute also, it will come, but small error will be there. Because of that error, account will not tally. So you will call it as a balancing figure. If you apply and see also, you will get it almost nearly only. Anyway, this is how these things will work, sir. Okay, e point again I wrote here. This is the entry you will write for interest income. This is the entry you will write for contractual cash flow. E above example ki the ACM table. E black box what is written is the closing balance of FA or FL under ACM will always represent the present value of future cash flows discounted at EIR. If that is not working out, ACM itself is wrong. ACM cannot be applied if this rule does not function. So this is almost the heart of ACM, a particular black box. Okay, come to next page. Next page, a very easy question is there, but important. On 1st May 2016, A Limited purchased an investment in shares of X Limited at rupees 40,000. Shares you bought, fantastic. The transaction cost paid is 2,000 rupees. The fair value of the shares on different dates is as under. May ending date ki fair value is given. June ending date given. July ending date also some fair value is given. Sir, fair valuation we should do at the end of the year, no? On balance sheet date. Why is he doing on every month, sir? Sir, this fellow is mad. He is preparing balance sheet every month end. I never told you should do fair valuation at the end of the year. I told you should do fair valuation on the balance sheet date. Imagine this fellow is preparing balance sheet every day. So you will do fair valuation also every day. Now tell me, sir. Pudu oka share undi you bought at 100 rupees. First year beginning. First year ending ki share value became 145. What is your fair value gain? 40. Imagine one company has fair valued the asset directly at the end of the year. He will get a gain of 45. Another company first fair valued the asset here. Later on fair valued the asset here. Ultimately fair valued the asset here. How much gain will they get? They will also get 45 only. No, here gain would have been 10. Here to here gain is 20. Here to here gain is 15. Ultimately gain is 45. Even if you do fair valuation every second also, overall gain will be same only. So it doesn't matter about when you do fair valuation. Ultimately balance sheet data definitely you have to do. That's the point. Anyway, show the accounting of the investment under FETPL and FETOCA. Sir, FETPL ki FETOCA ki what is the difference? Initial recognition amount difference, correct? There here it is fair value, there it is fair value with transaction cost. FETPL EIR is not to be applied, but FETOCA lo EIR has to be applied. Both the methods lo climax la fair valuation common, but the destination of gain or loss is different. FETPL it will go to Pural, OCL it will go to OCA reserve. Now, this is investment in which asset? See carefully. Shares. Shares ki EIR cannot be applied. You never told us this point, sir. I did not tell you true, but you should know this. Naturally. Sir, you are expecting too much from us. Not like that. Sir, do you agree that EIR is nothing but IRR? IRR can be worked out only when cash flows are constant. If cash flows are not constant, IRR cannot be worked out. Bond ki interest cash flows fixed untai sir. Loan given ki interest cash flows fixed untai. Loan taken installments are fixed. Equity share ki cash flows are fixed. What is my cash inflow in future? Dividends. Adi kuda expected. Will come or will not come a doubt. Even if it comes also amount don't know. How can you apply EIR? You cannot apply EIR there. EIR can be applied only when cash flows are fixed. When cash flows are fluctuating, IRR cannot be calculated. So calculation, when it is impossible, how will you account with that? You can't do that. So E particular sum, since it's related to shares, without EIR you have to do. Let's see first case. Look at this. Initial recognition happened at what value? Fair value. Transaction cost will directly go off into PRL, not part of the asset cost. Come to the end of the month, directly confidently write the fair value. Balance sheet, account will not tally. Difference will come. Put it off in your PRL. Gain it again, loss it loss. Second year beginning, starting point is 48. Second period ending ka fair value rate, closing balance, which is 45. Again there is a balancing figure. This time it's a loss, will go to PRL. Third month, starting point 45, closing is again fair value at 38. Loss again 7,000. Happily will go off into PRL. Always FETPL is the most easiest accounting, sir. But you don't have a choice to do that in the exam whenever you like. Sir, without seeing guess, how is FETOCA different from this? Starting amount difference. Here I wrote 40, FETOCL I should write 42. Apart from that, whenever you get a fair value gain or loss as a balancing figure, that will not go to PRL but should be transferred to OCI reserve separately. That's all. E-ledger also is sorted out. You know, today now your position is, you understand all the three methods. ACM how to apply, FETPL how to apply, FETOCA how to apply. Next our discussion is when to apply which method for which financial asset. That is our next discussion. We'll start. We'll see up to what level we can go. Easy only. I'll not trouble you much. Tell me, sir. Investment in equity share scheme. Standard ka original principle is you have to apply FETPL. Blind rule. Only FETPL. So any investment in equity share should be measured by applying FETPL, meaning initial recognition at fair value, transaction cost in PRL, no EIR, and on every balance sheet date you fair value, gain or loss transfer to PRL in the rule. When you apply FETPL, a fair value gain or loss, whatever is there, unrealized gain or loss, is it entering into your PRL? Will it impact your net profit? If it impacts your net profit, will it impact your EPS? Yes. Some companies, what they complain is, sir, I have an investment in equity share which I am not going to sell in the near future. I am going to hold it for very, very long term. So, when my goal is not to sell it in the near future, why should I fair value this? Our gains and losses, why should I put it in my PRL? Why should I let them impact my net profit? Why should I impact my EPS? Why should my shareholders feel good or bad every year when ultimately a good or bad is not going to be realized because I am not going to sell the shares in the first place? Standard says you are right. So let's reframe this provision. Investment in equity shares to be measured at FETPL, but if the entity wants, it can choose to measure the investment in equity shares at FETOCI on the first day. A choice has to be made. Once you make a choice of FETPL or FETOCI choice, only one day you have a choice. First day initial recognition. Whatever choice you make, adi irrevocable option. And after 1 year, I want to come back to FETPL. You can't do that. You can't shift over to FETOCI after 3 years. First day make a proper choice. Either FETPL or FETOCI. Whatever choice you make, you have to live with that forever. You can't reclassify the method of accounting later on. Reclassification is allowed, not for in equity shares. Other assets allowed. Investment in equity shares ki either FETPL or FETOCA choice is given only at the time of initial recognition. One more twist is there. If you follow FETOCA, entire fair value gain is accumulated where? OCI reserve. Will it come in PRL OCA section? OCA section. From OCA section it will again go to balance sheet? Yes. In balance sheet it will sit separately. I am OCA reserve. One day investments are sold. Investment accumulated unrealized gain now becomes a realized gain. Standard says don't recycle it to PRL. Recycling is not permitted. So what should I do with OCA reserve? You have to merge it directly into retained earnings. Sir, why like this? What did standard ka first principle was? I told you a story, no? History ka first line is what? Standard asked you to follow FETPL. Did you listen? You did overaction. What did you say? I don't want to impact my EPS. Did you say that? You said. That's the reason you selected FETOCA. You told that you will not sell the shares. But now you sold. Gain came. And now you want to release this to your PRL. Standard says, nahi chalega. I gave you option of FETPL. You did not select at that time. You chose which option? FETOCA. Live with that. Ultimately gain becomes realized. No, don't come to PRL. I'll kick you. Directly merge it into retained earnings. You told no sir, fair value gain not to impact my EPS. Don't change your goal post. You should not change. Wherever you kick the ball, there you should not put the goal place. Wherever it is there, it is there. The restriction. So if you ask me, OCA reserve recycling is permitted or not permitted? Why sir? Some cases are permitted. Why some cases are not permitted? That fellow told you happily follow FETPL, impact your EPSN. Did you listen? No. You selected the other option. He says, if you select this option, I will not allow you to recycle the accumulated gain to PRL even subsequently when you sell the investment. So directly have to merge it into retained earnings. This is the logic. Sir, this story if you remember, a main principle you will remember. Because item ko logic is there like that. Anyway, with that, you are done with investment in equity shares. Over. The next concept will be the last concept for today, sir. Only concept, no sums, nothing. Small concept, but confusing, important, easy also. Let's see. Last concept. Tomorrow also we'll discuss. It's not completely over. Little only will be over. Last aspect. Look at this, sir. Other than investment in equity shares, tell me all the financial assets examples. Start. Investment in debentures, huh? Okay. Bonds also same thing. Debenture, bond, both are same. Okay. Next. Investment in preference shares, huh? Okay, nice. What else? You tell me every list of financial asset you know, other than equity shares. Loan given? Very nice. Oh wow, trade receivables. I almost forgot that. More. Okay. Inka. Come on. Over. Prepaid expense I ordered. Yes, sir. Cash. Cash is financial asset, sir. What method will you apply for cash, sir? Any? Security deposit. FD is cash only, but anyway, now that you said it, fixed deposits. More. This line and the fill jail, sir. Big font I want. Tell me. Investment in convertible instruments. Not redeemable debentures, redeemable preference shares, but convertible or option to redeem or convert type of instruments. Or even perpetual bonds. What's the meaning of perpetual bond? Lifelong it keeps on paying you coupon but never be redeemed in lifetime, nor will it be converted. Only coupons you will get, interest every year. You add 10 more items also, there is a common discussion for that. Let it be any financial asset, either discussion. The discussion is, 3 methods are possible, sir. ACM, FETOCA, FETPL. Now when to apply which method is a discussion. Our standard says, you apply two tests. One is called as business model test. The other one is called as contractual cash flow test, also called as SPPA test. Full forms and all I will tell you. You will apply two tests. Based on the result of this test, you will decide whether to apply ACM, FETPL or FETOCM. Very easy, sir. Nothing to get confused. Our names are like that only. Matter is easy. Let's see. Business model test. In business model test, what you check is objective. Objective means, Asal, why are you buying this financial asset? Why are you holding this financial asset? What will you do with your financial asset? Asal nee plan enti? I want that. Sir, any fellow who purchases a financial asset, he should and he will fall only into these three categories. Only three possibilities are there. One, to hold till maturity. You will never have an intention to sell. Eventually you may sell, that's a different thing. But at the time of purchase, you are having full clarity. I will not sell. Bond life is 4 years. All 4 years I will hold. At the end of 4 years, company will give me maturity value. I will take that. I will never look at the market value because I never intend to sell it. This is a possibility. C is to trade. You purchased a bond. Your goal is hold it till good price comes, sell it off. Little fluctuation also will sell it off. Your intention itself is to do trading. A ki C ki middle lo B point is there. He is somebody who has both the features. He says, my objective is to hold till maturity, but financial asset can be sold also. Dual objective. I am okay with holding till maturity. I may hold it till maturity, but if a good price comes in the market, I will sell it off. So do you observe that his second objective is a kind of mix between A and C. A is purely holding till maturity. Asal sell ane idea he does not have. Third fellow only sell, holding till maturity idea not there. Both features I have. Adi B point. Three objectives say you can have. There is no fourth objective. This is the first test over, sir. The next one is contractual cash flow test. In contractual cash flow test, we don't test your objectives. We test your rights from financial asset. But financial asset you bought, asset gabati you will have a right. What right is this asset giving you? I want to know that. That I am calling it as point number D. What right is it is? This test is passed if financial asset gives a right to collect cash flows which are solely payment of principal and interest. Ade full form of SPPA. Solely payment of principal and interest. Put a D point if you have to pass. He says that you should have only one right. Okate right. What is that right? To collect cash flows. And that cash flow should be in the nature of principal and interest. Apart from collecting principal and interest, if you have additional rights, test is failed. 4 points I covered, sir. I'll more clearly write. Any additional right test fails. Test fails, what will happen? We will understand in a while. So how many points we have? A, B, C, D. A, B, C are objectives. D is your right. A, B, C are why you bought this asset. What are you going to do with that? D is because you are holding the asset, asset is giving you some rights. No, what rights do you have? That is D point. Now, standard guidance is like this. You will apply ACM if A plus D is satisfied. Go and observe what is A plus D. Your objective is to hold it till maturity. You never wanted to sell the asset. Next, asset also is giving you right to receive only principal payments and cash flow, interest cash flows, nothing else. In that case, you are supposed to apply which method? ACM. Sir, why should I apply ACM in this method? In this case, why should I apply? Tell me, sir. Do you want to sell the asset? No. If you don't want to sell the asset, why should I fair value the asset? Don't fair value. Are your cash flows fixed? D point satisfying, sir. D point, if it is satisfied, you will get only fixed cash flows. When cash flows are fixed, can I work out EIR? Yes. That's the reason ACM is given to you. You are interested only in interest income. You are not interested in fair values. When anyway you don't want fair values, why should I fair value the asset? So you should employ a method where only interest income is coming to P&L account and fair value fluctuations are not recorded at all. That's why ACM is given. Next. Apply FVTOCI if B plus D is satisfied. Who is B? Objective is to hold till maturity, but this fellow is daily checking market ka price also. Why? Nice price comes, he will sell it off. Am I having both these on different points? So on one side you say that I am holding till maturity. Therefore EIR lo interest income is accounted just like ACM is done. At the same time, since I am daily watching market also, fair value fluctuations also need to be accounted in my books like FVTPL. That's the reason when we discussed the methods earlier, you observed that FVTOCI is a mixture of ACM and FVTPL. Here also you see B is a mixture of A and C. Since the method, since your objective is mixed objective, method given also is a mixed method. It is neither ACM nor FVTPL, it is a mixture of both. Sir, why should I apply this mixture ka method? Because your objective is a dual objective. Therefore, FVTOCI is created. And when you apply FVTOCI here, reclassification is allowed here. Sorry, you told we will not allow. That is for investment in equity shares. Investment in equity shares ki OCA reserve reclassification is not allowed. Remaining every asset kit is allowed. It is allowed. Sir, why are you allowing, sir? Cheating? No, sir. No cheating, sir. Sir, I have an intention to sell on a point. First day only I told. Did I tell you? Yes. What did I say? My objective is to hold. Plus it can be sold also. Did I tell you that? I told you. That is the reason I applied FVTOCI. That's the reason I fair valued it. But whether I will really sell or not, I do not know. That's why I kept it in OCA reserve. I did not impact my EPS by putting it in PRL. But one day I actually sold it off. Now I should impact my PRL. Bring it to PRL. Make it net profit. Let your EPS get impacted. Because you had intention to sell on first day also. But clarity is not there. Whether you will really sell or you will hold it till maturity. Here logic is different. Investment in equity share logic is different. Investment in equity shares, tell me, sir, holding till maturity possible? Will any idiot hold investment in equity shares till maturity? As maturity is there, equity shares definitely has to be sold. It's just a matter of time. If not 5 months, 5 years. If not 5 years, 15 years. Investment in equity share has to be sold to realize that again there is no other way. That's why standard told you FVTPL. Did you listen? No. I want to follow FVTOCI. Follow. OCA reserve, don't recycle it to PRL. But this is not like that. This is the bond investment. I have the option of investing till or holding till maturity also. Then what did I decide on day one? Either I will hold it till maturity or I will sell it. Both the options, both the eyes I kept and watched. Eventually I sold off. But first year, second year low, whatever fair value gains are there, you parked it in OCA reserve. Now you release that to your P&L account. Because selling objective was always there in my mind. Therefore it should impact your EPS. Sir, in my mind means who am I? I'm the management of the entity. I'm the MD of the company. I'm having 40% or 50% shares in the company. The other 50-60% who are there in the public, who are not there in the management, but they are also shareholders, they should also see what is my intention. My intention is fair value fluctuations. That's the reason I sold. It should impact my EPS. Since that's my intention should be made clear to the reader of financial statement also. Recycling is allowed here. If you guess the third one, you are pro max. The last one, sir. Over with this. That much you can guess. After that. That's the reason I asked you to follow FETPL. No. If you follow FETPL, there's no problem. But if you follow FETOCA for investment in equity shares, standard says reclassification is not permitted. That's a kind of, discouragement to follow FETOCA. That's like that. Anyway, tell me this. Apply FETPL when? Don't see it. Any other case. Any other case, and who will fall? Of course, C plus D will definitely fall. There is no doubt. Any other case means every other case will fall in that. No. Who is C? My objective itself is to trade. I never want to hold it till maturity. Sir, when you never want to hold it till maturity, a final maturity date principal amount, will you get that? If you don't get that, how will you work out EAR? Put EAR calculate cheyalante whatever cash flows are there in the timeline, everything you should receive. Then only EAR will work. But when you know that you are going to sell off the sell off the asset before the maturity date, how can I apply EAR? Don't apply EAR. Which method is there without applying EAR? Only one method. FETPL. Go and apply FETPL like that. Not only C plus D. A plus D ka failure also. B plus D ka failure also. Sir, you may be having an intention to holding till maturity, but if D point fails, you cannot apply ACM. You cannot apply FETOCA. You have to apply FETPL. Sir, one last case of when D point will fail. Only one last case. This is logical guy. You should answer. All of you, sir, please pay attention and answer. I know you are tired, but no choice. Listen. Sir, I purchased one bond issued by Reliance Limited. E-bond is a redeemable bond. Next 5 years, every year 100 rupees interest it will pay me. At the end of 5th year, they will pay me 1000 rupees principal amount maturity value. There is no conversion option at all. Tell me, sir, what right do I have? I have right to receive interest cash flows. I have a right to receive principal cash flows. D point passed. D point satisfy you, sir. E point. Now, which method to be applied for this asset depends on what is your objective. If my objective is to hold until maturity, ASM yastam. Hold and sold both are there, FETOCA. I have right to receive fixed cash flows only, but I don't intend to receive that because I'm going to sell it off before maturity. In that case, I will apply FETPL because I'm passing C there. Are you clear here? The basic version. Look at modified version. Again, I bought investment in Reliance shares. 3 years bond. First year he'll give me 100 rupees. Second year 100 rupees. Third year 100 rupees. Third year ending, he is giving me equity shares of Reliance. Not principal amount. Principal amount place low, he is giving me equity shares of Reliance. Indirectly put convertible bond. I did not issue, I bought. Since I bought convertible bond, next to 3 years ka interest cash flows I will get. Third year ending low, principal is not coming. Shares, 10 shares I am getting. Now when you are having a right to receive shares, a shares ka value, will it be equal to your principal amount? It will never be equal. Appudu em jarigindi sir, D point fail ayyo. Once D point is gone, your ACM, FETOCA are gone already. You have to apply only one method. Which method? FETPL. Are you understanding, sir? Why I will tell you. Last case. Sir, you told last case 10 minutes back. I lied. Sir, 100, 100, 100. Here, sir, at the end of 3 year, holder has a choice. Either I can get 1000 rupees cash or I can get 10 equity shares. You have to tell me whether D point is passed or failed. That's exactly what I want. Sir, this is investor. He is putting God promise, saying that, sir, I will take cash only, sir. He is putting God promise. That means, idi cash vastundi, idi cash, idi cash. Last I have a choice. But this fellow says, as stupid shares and all I will not buy, sir. I will take cash only. He is putting God promise. And therefore he says that, I will get only cash flows. 100, 100, 100 and 1000. Cash flows are fixed. Since cash flows are fixed, I can apply AR also. And I intend to hold it till maturity. And therefore he wants to apply ACM. Standard says, I'll kick you. Why? Do you have a right to receive shares? Whether you will take shares or not irrelevant for me. Do you have a right to receive shares? Do you have? Gone D point is. What did you understand the meaning of solely? Solely. Solely ka meaning ain't, sir? Only that. Extra cheyadu. Principal receiving right maatrame undali. Extra unte gone na point. Sir, ain't sir me problem? Why are you worrying about only principal? Let him have that right, no? What is your problem? Let him have right. He is putting God promise, no sir. He will take only cash. Why are you not applying ACM? Why are you forcing him into FETPL? There is a logic. The logic is very deep, but you will understand. The logic is, interest means what? Normal interest means what? Whatever return you get for the money given. You give your money to SBI. How much return will he give you? FD lo 6%. But ade money, instead of giving to SBI, you give to a risky fellow like me. How much return will you expect? 6 more? More. How much more? Roughly 10%. There is somebody whom I have introduced to you today only. You don't know him. He is wearing nice formal shirts and all, looking decent. I told you that he is CA. He is asking money. At what rate will you give? But you don't know him. Little more. Means depending on the risk, return also will change. Isn't it, sir? Now, Reliance Industries, sir, for the risk what Reliance has, they should offer me a interest rate of 14%. Ideally, for the risk. How much are they offering? 10%. You know why are they offering? Because there is a convertible instrument. Gabati, he reduced the interest rate. What our standard says is, when I told that you should have a right to receive interest, interest is not some stupid interest. Interest should be 14%. Are you receiving 14% interest? How much are you receiving? 10%. Why is your interest rate tainted like that? Because apart from principal, you are having some other right. Presence of some other right other than principal and interest will basically affect the amount of interest what you receive. That interest is interest according to the contract, but not interest according to the eyes of Ind AS 109. Ind AS 109 says, for every 1 rupee you give to Reliance, you should earn a return of 14. But that fellow is giving you 10%. A 10% is not interest according to the standard. Instead of telling you all these points directly, what he says is, if you have one extra right, if Reliance is giving you this right to receive equity shares, definitely this is reduced. The moment interest amount is compromised, you fail the definition of interest. This is sir. D mottam. Like that, it's very deep. I understand it's deep, but how you remember is D points. Now, why I have to tell you all this is, every point I'm telling you is a question. Every point is a question. No overaction. We don't have time for that. No show off. Any questions, sir, you can watch in the material. They are there. I did not create. ICA created. They're all there. Some are taken from direct IFRS 9 original questions. ICA has taken. We also copied. Matrices. Logics baga raval, sir. Now tell me, sir. Investment in convertible bond, which method is applicable? Investment in convertible bond, which method is applicable? Objective you want, you don't want. Investment in convertible bond, do you ask me business model or you will not ask me? You should not ask me. Why? Convertible bond lo SPPA test bothun, sir. whatever you are every year receiving as interest, that is not interest according to the standard, because that is tainted interest. You are not getting adequate return. Gone. D point. D point fail, what will happen? Which method you have to apply? FVTPL. But if it is investment in pure redeemable debenture, then you will ask me, what is your business model? Accordingly, ACMI, FVTOCA, FVTPL, like that. So, first చూడాల్సింది not A, D. D చూడాలి. What right you have? DA failure అనుకోండి సార్, ఇంకా ఫర్దర్ డిస్కషన్ ఇల్లే. FVTPL. Clear, sir? Enjoy, sir. Sleep on this. We'll see you tomorrow. Revise and come.